Dear friends, in this video we will talk with you about economic recession. What is it, its causes and how can it be treated? A recession is a substantial, popular, and extent downturn in economic activity. A typical rule of thumb is that 2 consecutive quarters of negative gross domestic product, GDP, growth lead to recession. However, numerous use more complicated methods to determine if the economy is in recession. Unemployment is one crucial attribute of recessions. As demand for goods and services drops, corporations will need fewer workers and could lay off employees to cut costs. Laid off staff need to reduce their own investing, which in turn affects demand, which in turn might lead to more layoffs. Economic recessions could be triggered by several various factors, such as loss of consumer confidence, high interest rates, a stock market crash, and asset bubbles flooding. Most occasions that will trigger the economy to slow down will also result in a recession if left uncontrolled. Whenever consumer confidence decreases, demand and economic growth decreases, which can result in a recession. High interest rates or a insufficient capital accessible to borrow can lead to a recession. The 2008 recession was caused by a property bubble and irresponsible loaning procedures. The 2020 recession was brought on by the COVID-19 pandemic, that compelled many companies to close or scale back as a way to avoid the spread of the virus. Loss of consumer confidence. Loss of confidence in the economy encourages consumers to cease purchasing, which may cause an aggressive cycle. If the demand for goods and services is completely diminished, which will then ultimately minimize business income and the need or economic capacity to employ more workers. That signifies the economy will create less jobs, sales will keep on to slow, and producers will often reduce production in reaction to the dropping demand. Reducing production likewise implies lowering on jobs, which contributes to a growing unemployment rate, which will then lead to people restricting on their paying out. Does GDP point out a recession? A decrease in gross domestic product. GDP growth is usually outlined as a cause of a recession, but it's even more of a caution signal that a recession is currently underway. The GDP is only claimed after a quarter is over, so the recession would have likely already been underway for a few months by the time the GDP switched negative. A stock market crash. When the stock market crashes, that can result in a recession. Since stock prices go lower, traders usually have fewer capital to invest in businesses. If enterprises can't increase funds for expansion and operating costs, that may cause layoffs or employing freezes. Many of the key stock market failures in United States history instantly preceded a recession. These incorporate the stock market crash of 1929, also recognized as Black Tuesday, the 2008 financial crisis, and the short-term crash because of COVID-19. Post-war recessions. Post-war recessions have occurred often in U.S. history. There were recessions after World War II, the Korean War, the Vietnam War, and the Gulf War. The normal growth subsequent the Korean War, the Vietnam War, and the Gulf War gone down 4.5%, and the average unemployment rate gone up an average of 1%. High interest rates. Higher interest rates make checking out money more costly, which discourages customers and corporations from credit funds in order to make purchases or investments. The decreased spending results in a lowered demand in goods and services in the economy. The reduce in demand and following cutbacks on manufacturing next cause businesses employing fewer persons. As investing in the economy goes down, inflation decreases, yet if high interest rates result in the economy to contract too much, that can certainly cause a recession. When asset bubbles burst. Asset bubbles take place when the costs of investments such as gold, stocks, or housing become higher outside of their sustainable value. The bubble itself sets the stage for a recession to happen when it bursts. The dot-com stock bubble and the housing bubble emerged right before the recessions of 2001 and 2008. Credit crunches. A credit crunch happens when there is an unexpected lack of capital accessible to lend, which indicates there are fewer loans. For instance, during the 2008 financial crisis, banks encountered massive losses because a lot of mortgages were defaulted on, and because they had purchased poor mortgage debt. These losses meant that they were very hesitant to loan out money. When loan companies turn into more cautious, interest rates go up, and there is less cash available for businesses and customers. That can result in a recession. Deregulation. Lawmakers can bring about a recession anytime they get rid of significant precautions. The seeds of the savings and loan crisis and the following recession were grown in 1982 when the Garnes-Teacher Main Depository Institutions Act was handed. This and the Depository Institutions Deregulation and Monetary Control Act of 1980 eliminated loan-to-value ratio and interest rate cap constraints for savings and loan organizations. The savings and loans crisis triggered the 1990 recession. Over 1,000 banks, with overall resources of $500 billion, failed as a response to land flips, doubtful loans, and unlawful activities. Deflation. Deflation decreases the value of goods and services getting sold on the market, which stimulates folks to hang on to purchase until prices are cheaper. It is often connected with high interest rates, which can also trigger people to wait to make buys, since they cannot manage to take on debt at such high interest rates. Deflation may also result in a rise in unemployment, since companies will need to cut costs. This could lead to a deflationary spiral, because unemployed people cannot usually spend money to assist the economy improve. Dears, this is what I wanted to tell you about economic recession. What is it, its causes, and how can it be treated? Don't forget to comment, subscribe, and like. Thanks. See you soon.